Imagine an offshore pension fund in which the income you earn, including capital gains, cannot be taxed by the United States until you receive a distribution from that fund. And even when you receive the distribution, portions of the distribution may be received tax-free. A fund that contains few restrictions on the kinds of investment income that are covered. Welcome to the Malta Pension Plan, a type of supercharged cross-border Roth IRA. Here in the U.S., a Roth IRA is a tax-favored retirement account. Although contributions are not tax-deductible, all earnings of the Roth accumulate tax-free, and qualified distributions are not subject to federal income tax. But the maximum annual contributions are only from $5,500 to $6,500, and you can't transfer in-kind property to a Roth without triggering excise and income tax on any built-in gain. The bottom line? Roths are great, but the benefits just aren't available to high-income taxpayers like you. But with the U.S.-Malta Tax Treaty of 2011, a unique opportunity exists. This tax treaty, ratified by the United States Senate, has very favorable provisions that can result in significant tax benefits to U.S. members of a qualifying Maltese pension. After-tax benefits include unlimited contributions, including of stock in private or publicly traded companies, partnership and LLC interests, and interests in U.S. or non-U.S. real estate. There are no Maltese limits on pension contributions, but in practice, for U.S. tax purposes, there are case-by-case limits based on what the opining U.S. tax attorney is comfortable with qualifying as a pension for U.S. tax purposes. Our rule of thumb for a limit is 1/3 to 1/2 of net worth, and that needs to be supported by a comprehensive financial plan that the opining U.S. tax attorney considers in writing the opinion. Malta law generally allows distributions from such plans beginning at age 50. Sound too good to be true? Well, consider that the underlying legal principles are very much like those that apply to the Roth IRA in the United States. As long as your Malta pension plan is formed pursuant to Maltese law and more than 75% of its members are U.S. and/or Maltese residents, the initial and further specified lump sum payments are not subject to Malta or United States income tax when made to a U.S. resident beneficiary. All of which is why we call the Malta Pension Plan the supercharged cross-border Roth IRA for high-income taxpayers just like you.
Hi, I'm Michael Wallace. I'm CEO and founder of Wallace Investments. We specialize in implementation of tax strategies to save money on your taxes every year. Probably have more tax strategies than anyone else. We have a specialized program where we can actually prepare your tax return and implement our specialized tax strategies free of charge. If you're interested, see my contact information. Thank you.